When oil prices explode, do oil stocks follow? That's the question. Welcome back to SkiesCapital. Today we're looking at the question that matters every time oil markets go into shock. When oil explodes higher, do the stocks actually follow? Because history gives us a clear lesson across three major shocks: the 1990-91 Gulf War, the 2002-2003 Iraqi War, and now the 2026 oil shock. Crude moves faster than the oil equities. That is the idea behind this presentation. In 1990, oil surged 125%. In 2003, the shock was smaller. Thus, the stock reaction was smaller too. In 2026, crude has spiked again, while the majors are lagging once again. So from a SkiesCapital perspective, this is not just a story about oil. It's a story of how the markets separate the commodity headlines to the equity reality. Let's walk through all three of these. Let's start with the 1990-91 Gulf War. This was a large physical supply disruption. Roughly about 6.5% of the entire global supply was taken offline. The markets reacted as expected in a true supply shock. Oil rose from $16 a barrel in late July 1990 to around $36 a barrel in September. That's roughly about a 125% move. Now, look at this chart that I had made up. It starts with a 0 point, and then it shows the percentage change of the oil, actually not of the S&P and the oil companies. So the major oil companies clearly outperform the S&P 500, which makes sense. Investors recognize that oil prices would support cash flows and earnings for those major companies. Actually, if you really look at it, Exxon was the one to buy. It made it up over 30%. But in any case, the important point here is none of these stocks behaved like the crude oil futures. They held up much better than the markets, but they still lagged far behind the oil spike itself. That is the first big lesson. Even in true supply shock, integrated oil companies are not pure oil proxies. They are still diversified businesses. The market still prices in recession risk, duration risk, broader equity conditions. As the best read on the 1990 is, the integrated oil stocks act as relative safe havens, not one-for-one oil price substitutes. Now compare this to the 2002-2003 Iraqi War. This was a smaller disruption from the start. The gross loss to world market was only 1.9%, much smaller than what was in 1990. Also heavily offset were the other producers. They anticipated, they knew it was coming, so they started producing more oil. So this was not the same kind of physical supply shock. Oil did rise into the oil scare, but or the war scare, but when the conflict actually began in March of 2003, the market faded, prices fell, offset rather than exploded higher. And you can actually see that in the difference in the chart. The equity response was much more mixed. Instead, the dynamic oil shock reaction was much more of a gradual energy up cycle combined with a broader market recovery. So you can see that they sold off it before the war actually began. And actually the war began, oil bumped up a little bit, but then the stocks took off. And you can see that with Chevron and Exxon were actually the big winners in the process of this event. The distinction matters here because in 1990 the market was dealing with a true per barrel oil shock. In 2003, the event was much better anticipated, better absorbed, and less threatening to a global supply. So the majors did not trade like crisis winners in the same way. From a SkiesCapital perspective, the clean takeaway is in 2003, the more the risk event than a true supply shock crisis. And when the market sees this disruption that way, the oil stocks do not get the same kind of sudden reaction. Now let's look at 2026. This is where the history comparison becomes especially useful. Crude oil has surged faster than the majors, while the S&P 500 has weakened. The pattern should look familiar by now. Reuters reported Brent moved from $81.40 on March 3rd to an intraday high of $119.50 on March 9th. That is roughly a 47% move in less than a week. Now compare that to the stocks. And February 27th to March 9th, Reuters reported Shell up 4.9%, BP up 7.8%, Chevron only up 2.6%, and Exxon only up 0.9%. So yes, the majors are moving up, but relative to the crude oil, they are barely moving. And that is the message from the tape. Investors see a temporary shock more than a durable new oil cycle. That is why this slide matters. The market believes this was the start of a long-lasting structural supply loss. You would likely see much stronger moves in the major oil companies. Instead, what you see is a caution. The market is saying this may be serious, but it may also be temporary. And that tension is exactly what the investors need to watch from here. So what do these three shocks tell us about oil equities? The pattern repeats. The bigger the commodity shock, the more useful the majors are as relative winners, but never a pure substitute for oil futures. In 1990-91 the Gulf War, oil was up 125%. The majors beat the market, but nowhere near what the crude oil did. That means that remains the best historical template for a true supply shock. In the 2002-2003 Iraqi war, oil rose into the war, then fell on the onset. The reaction was more mixed, more cyclical, less shock-driven. The episode is better viewed as a risk event than a true supply crisis. But now in 2026, oil shock, Brent was up 47% from March 3rd to March 9th peak. The majors moved only modestly, but the broader market weakened. So here's the investment framework. If the market fears a real lasting barrel loss, the majors usually outperform the broader index, but they still trade like a diversified cash flow business, not like an oil future. That is why the shock gains are consistently smaller than the crude oil move. Now as I'm recording this, the oil prices have traded all the way back down to the mid 80s again. What a wild ride. But the key to this, there is still a real threat to the Straits of Hormuz, with roughly 20% of the world oil supply moving through that corridor. So the story isn't over yet. Will be very interesting to watch. And this is SkiesCapital takeaway. Oil shocks can create opportunity in the majors, but only if they understand that you are buying a disciplined energy business, not barrels of oil in a storage tank. Tell me what you think. Tell me what your takeaway is on this event. And if you like, I can do a financial analysis on Exxon, Chevron, BP, and Shell on a follow-up video. Please remember to like and follow the channel. This is SkiesCapital from 35,000 feet. Thanks for watching.